But thanks everybody for joining the mid-year outlook. Been a pretty interesting start of the year so far. A lot of mixed data. So today we're going to go over quite a few charts. Going to try to make it relatively concise, as concise as I can make it. Sometimes I get to rambling, but I'll try to keep it a little bit tight for everybody. We do have a Q&A. The Q&A button should be along the bottom of your Zoom menu. Feel free to ask questions as we go along. We've got Whitney, who's going to be kind of keeping an eye on the questions and answers that you have. We'll have a dedicated time for Q&A at the end, but if you do have questions along the way, I'd really like to answer those as they come up, because it's probably pertinent to the discussion at hand. So please don't hesitate to type in your questions there. So we're going to go over recession probabilities, talk about markets, go through a banking update, talk about a series of economic data, look at portfolio positioning, and look at some scenarios for the second half of the year and beyond. So let's go ahead and get started. We're starting with the recession probabilities really for two different reasons. One is really whether or not we go into a recession is really going to drive equity prices over the next 6 to 12 months. And the second reason why we're starting with the recession probabilities is it just shows you just how much dispersion we have in the data, and the different projections for whether we're going to enter into a recession or not. So the probability model by Deutsche Bank, keep in mind the three models that we're going to look at is all based on data. None of the probability models that we're looking at is somebody's kind of guess as to whether we're going to go into a recession or not. So the first one is from Deutsche Bank, and it's basically saying currently that there's a 100% chance of us entering into a recession. We're not going to go over every little data point there, but it's more to contrast with the next one, which is the St. Louis Fed. Their model suggests essentially a 0% chance of a recession. So here are two completely analytical database models that are widely different as we could possibly get, 100% versus 0%. The reality is probably somewhere in the middle. This is the Philadelphia Fed. When we look at the Fed meetings over, about once a month, sometimes their language can be pretty mixed. This is a good example why. They have one of their Fed groups, the St. Louis Fed, saying there's 0% chance of a recession, and the Philadelphia Fed that's saying there's about a third, 33% chance of a recession. This seems like it's the most likely at this point, somewhere between a 30 and 50% probability of a recession. Those probabilities, like we can see right here, we had this big spike up really from kind of the end of the first quarter of last year through the kind of the first quarter of this year, really started to see this increase of recession probability. Over the last couple of months, we have seen that go down. There's been some data suggesting, especially in the equity markets, suggesting that maybe the likelihood of a recession isn't quite as high as it might be. Even the large investment firms are kind of at odds with this. Morgan Stanley, for example, is essentially saying there's a 90 to 100% chance of a recession in the next 6 months. Goldman Sachs is more about the 30 to 40%. Bank of America is somewhere in the 30 to 50%. So we're seeing it's just this wide dispersion of recession probabilities just exemplifies how mixed the data is right now. So let's start looking at some of this. So looking at the equity markets, this chart shows the S&P 500 in blue, the Dow Jones in burnt orange, and the small caps Russell 2000 in green. this dotted line right here is the start of this year. So this is the December 31st time frame. We started to see quite a bit of dispersion over here, kind of in the fourth quarter last year, and we've really seen it continue over here. The Dow Jones had a big run up in November and December, and is below its December lows right now. It's up slightly for the year, but really not that much. But it had a lot of this recovery in, like I say, in the the fourth quarter last year. The S&P 500 is doing the best besides the NASDAQ. S&P is up about 13% year to date, almost exclusively led by big tech. We'll talk about that in the next slide. The interesting part here is that small caps and mid caps, if we look at this kind of October low time frame here, we've seen the larger companies, the Dow, the S&P, the NASDAQ, that are cap weighted, kind of driven by some pretty big stocks, drift higher over the last 8 or 9 months. Compare that to small caps, and mid caps look almost exactly the same. They're the same place that they were. They've kind of been really choppy and ultimately haven't really gone anywhere. This is pretty strange because the S&P and the NASDAQ are showing some very resilient signs that maybe the low from last October was a major low. There's been a lot of positive things, especially over the last kind of 4 to 6 weeks that we'll talk about here in a second. But it's very unusual for this dispersion to happen, where you've got the larger companies really dramatically leading the smaller and mid-sized companies coming out of a major kind of bear market low. Usually it's just the opposite. Usually what we see is the small caps, the micro caps, the mid caps, kind of the more aggressive, kind of more cyclically sensitive areas of the market really start to outperform after we see these major bear market lows. So it's pretty unusual to see this kind of behavior. Now, part of that is the regional banking crisis that we saw in March. So if we look at the performance right here, this big drop in the green, which is the Russell 2000, there's a much higher percentage of bank stocks in the Russell 2000 than there are in the Dow or the S&P. So this drop was, kind of a 7 to 9% drop for the Dow and S&P, when we saw closer to a 13 to 15% drop caps because of an overweight to those smaller banks that showed more volatility. Just kind of an unusual data point. A couple things that could happen. We'll talk about this in a little bit, but the question is, are the large caps going to kind of stall or pull back a little bit, and the smaller and mid-sized companies play catch up? Or are we going to see these sort of continue to flounder around and see the larger companies kind of catch down to small caps? But it's unusual. This is kind of the driver of that chart. So if we look, this is a few weeks old, but if we look at the largest 7 stocks in the S&P 500, Meta, which is Facebook, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, those 7 stocks accounted for 100% of the gains of the return for the S&P so far year to date. The other 493 companies have a 0% return. That's pretty amazing. It's very, very, very narrow. And again, that also can be a good thing, because if these other 493 really start to do well, and we start to see those other companies start to play catch up, then you could see the S&P, maybe these kind of flatten out. Maybe the S&P kind of flattens out, but these other 493 start doing better. There's some opportunity for some outperformance there. But it's been an extremely narrow and very, very unique and rare kind of time so far this year. Here's the S&P 500. A lot going on in this chart. Here's the highs from early last year, early 22. And let's kind of focus out here on the right, the last few months. So we had this big area of support and resistance. So early last year, this is when the Ukraine war started. We saw kind of this 4,200 to 4,300 range really hold up pretty well. We saw a retest of it second quarter last year. August, we had this big rally over the summer, last summer. It reversed lower. Here's the low for the cycle so far in October. We saw the market come back up and test this, pull back a little bit. And then we saw it kind of chop around sideways, kind of trying to break through it. This 4,200 level is pretty darn important. This is a very positive 6 weeks of a major resistance level like this break. That's a very, very positive. So if we look at, generally speaking, a bull market is higher highs and higher lows, kind of what we're seeing right here. We saw a high, we saw a low that stopped higher than this low. We got a high that stopped higher than this high, a low that stopped higher than this low. So we've got higher highs and higher lows. That's a very big positive. Well, this August high last year, if the market really couldn't get above that level, the risks were still very high that this is still an overall downtrend. But for the first time about a week and a half ago, we finally saw the S&P break above this high. So now we have a high above that August high. We also have the 50-day moving average right here, which is this blue line, kind of hard to see. That's been trending positive and kind of started accelerating higher. Another very good sign is that this 200-day moving average, this red line, also started to flatten and has started now to subsequently turn higher. So there's this over the last 6 weeks is a very positive development. Now it could easily get reversed lower if we start to see some recessionary signs, and this be kind of a head fake higher, but over, up until this point, caution really had been warranted. And we're starting to see some very positive developments. The other thing that we've seen, this is called RSI, it's called relative strength. This is positive that we saw such a high reading right here. So sometimes what we can see, if this is going to be a major market high, we see what's called a divergence. So if we look back here to the last part of the bull market that ended the first part of last year, if we look here, we had higher highs in price, but we had this lower relative strength. The internal moves in the market weren't quite as strong. That's a very strong signal that there's some topping type of activity happening. We could have seen that right here. If we would have seen that, if this relative strength would be a little bit lower and we have kind of a lower high right here, that puts this breakout higher in much more question. But the fact that we saw a very strong reading is at least hope that maybe the overall context of the market is starting to change a little bit. Now, granted, we move into new lows, but it's still, we have to take that as an overall positive. So, it's a little bit overbought. It's starting to work that off. But like I say, some of the technicals of the market are starting to look a little bit better. Small cap. So this is the Russell 2000. Again, really has not been showing much strength. So if we look at the Russell 2000, typically we'd like to see this being performing better than the S&P. If I'm going to flip back and forth here, if we look at this high, it's lower than the highs from January, February, lower than the highs from August. opposite. So we're higher than the highs from January, February, higher than the highs from last August. That said, this is a little bit more reflective of the overall economy because we don't have those 7 stocks in there. But one of two things can happen again. Are the large caps at risk, or are the small caps gonna start playing catch up? So it looks like we've got a question. Throw out the outliers to show market technicals. I'll pull up an equal weight RSP here later on during the Q&A and kind of show what that looks like too. It looks very similar to the small caps, a little bit stronger, but very similar to the small caps. So that's kind of the major question in the equity markets. What's going to happen? Small caps going to play catch up, or are the bigger companies going to kind of, start to falter? Another way to look at it, we've looked at this quite a few times over the last few years. It's a big driver of market performance, and it's the Fed balance sheet, kind of overall liquidity. The gold line is the Fed balance sheet, and the blue line is the S&P 500. You don't have to be a statistician or a nuclear scientist to see that there's a correlation. An interesting thing that we've started to see recently is, despite the market kind of breaking out of this range, we've seen a decrease in net Fed liquidity in the system. So we really haven't seen many divergences like that over the last 10 years. The market has been pretty consistently following the ebbs and flows of Fed liquidity in the overall financial system. I mean, even all the little wiggles are pretty consistently mirroring each other. We've started to see this divergence. That kind of suggests that the S&P is probably, those bigger stocks are probably due for don't know if it's going to kind of catch down here. That'd be a very bearish development if we saw something go all the way back down to where the liquidity is. But it's definitely something that we need to keep our eye on. So despite some of the positive positive technicals that we're seeing in the markets recently, there are some big drivers of performance that are starting to show some warning signs here. So it's something that we just need to keep our eye on. Again, it goes back to the mixed signals. Switching gears a little bit to the bank stocks. So, we had a few of the largest banks in U.S. history fail. It was kind of a 2-week mini panic, and it's sort of gone away. At least it doesn't seem to be affecting much. This is the performance of 2 different ETFs, KRE, which is a regional bank ETF. So think the smaller kind of Frost Bank type of banks, and then KBE, which also includes the big guys, the Bank of America, JP Morgan, and a lot of the other smaller banks. You can see when we started to see that risk in March, it just completely fell off a cliff. The concerning part, or the opportunity, depending on how you like to see it, is we just have not seen these banks do anything from there. They've kind of hit the floor and they've bounced around here. If we're to expect the overall market to start playing catch up, we really need to have these banks starting to show a little bit more potential for a bounce. So it's definitely something that we need to keep our eye on. There are some concerns why we shouldn't expect that, and that's the commercial property loans. So this looks at, commercial real estate is a very, very big market. It's a very diverse market. It's not just office buildings, but there is a lot of concern there. Interest rates have gone up tremendously. And one of the key things to watch for the next 6 months, and really for the next few years, is what is going to happen when these property loans on commercial real estate start to renew. So it's kind of like if you had an adjustable rate mortgage. Let's say you had a 7-1 arm. You have a 7 years where you have a fixed rate mortgage, and looks like we have a question: how to maximize chart and minimize Jim. I'm not sure what my face looks like to y'all. I've got this hopefully, but I know it's as big as I can get it on my screen, so I apologize if my face is interrupting everything. Maybe if I move it over like that, does that help a little bit? But that could be something that maybe it's just kind of on your iPad or phone or something like that. But as if you have this 7-1 arm, you have a fixed rate loan for 7 years, and then it's going to go to an adjustable rate. Well, this data is showing how much of the commercial real estate loans are going from a fixed rate to an adjustable rate. And, right now, for the remainder of this year, we have almost 400 billion coming due. Next year, there's a $500 billion that's rolling into floating, another 450 billion in 2025. And you can see who holds this. So banks in black, have about 35% of the loans that are maturing. Securitizations, those are different products that think 2008 securitized mortgage obligation. So we got a suggestion to click on the screen and move the line between Jim and the chart. Might be able to help reduce the size of my head on the presentation for you. So the securitizations is really the concern here. What's going to happen with that? That was an issue in 2008, that the subprime mortgages on residential real estate were securitized and cut up into pieces and sold as bigger things. It's over 50% of the commercial loans. So there is real risk here. We're not out of the woods. The banks are not out of the woods here. And I think the overall markets are not out of the woods here. It doesn't necessarily, this isn't all office loans though. Office buildings are probably the most at risk here, because we've got about a 50% sort of back in the office nationally, about 50% occupied rates versus pre-COVID levels. So this isn't all office space, so office space is about 15% of the overall commercial property loans. Those are definitely at risk. But the question is, and the wild card is, what are the banks going to do with these loans? So they don't necessarily have to just immediately call the loan. They could. Let's say there's a $100 million loan on an office building, and it's in September, it's going to go to floating rate. It could go floating at 9 or 10%. And that kind of increase in the cost of the debt essentially destroys the cash flow on that commercial property. So the owner of it has the ability to pay a higher interest rate and essentially lose money on the property. They can try to sell it. They could try to work with the bank. And I think at first we're probably going to see a lot of this workout happen. Where banks say, look, just try to keep making loans, and we're gonna wait and be patient to see if we can get out of this thing. So I don't know if it's going to be an issue the second half of this year, but if it keeps happening, at some point, the owner of the building is going to sell, even if it's at a discount, if it's at a greatly reduced value. At some point, the banks are going to say, look, we're not going to lose money on this, and we need our money out, and we're going to force you to sell. So there's a lot of potential ways that this could play out, but it is a really big issue that's going to be pending. And it's just it's something that we're going to have to really watch very closely. Switching gears. So let's start to look at some economic data. We've talked about this quite a bit. Yield curve has a very good success rate of predicting a recession. 100% success rate. It has not been the case so far. So there's some interesting things here. So on the one hand, if we look at the success rate of the inverted yield curve predicting a recession, every time it's happened, a recession has followed. On average, it starts 12 to 18 months after the initial inversion. It initially got inverted about late February of last year. So if we look at the 12 to 18 months, that says kind of August plus or minus, plus or minus a month or two. So we're really starting to run out of room from this, potentially being continuing its 100% success rate. So the question then becomes, well, why would it not be? Why would it be different this time? And it's pretty easy to make an argument that the Fed has so skewed the interest rates markets by keeping interest rates at 0% from 2009 to basically this time last year, early last year. And then they jack up rates 500. Of course, it's going to be inverted. The bond market is an extremely large market, and when you price everything for so long, the Fed was projecting that in late 21, in December of 2021, they were projecting that interest rates 18 months from now, which is right now, would be at 1%. So their own projections 18 months out is that they were going to go from 0% to 1% over that subsequent 18 months. They went from 0% to 5%, over 5%. So, but they set the expectation that rates were going to be extremely low. Banks did that, insurance companies did that, pension funds were extending duration under the impression that rates were going to remain low. And obviously they've exploded higher. So when that happens, when you get the front end of the yield curve massively going up very quickly, of course it's going to get inverted. So it makes sense that maybe the timing of that is a little off. But if we look over here at the far right, this is the amount of the inversion. We are currently the most inverted that we've been since this cycle began. So if this was truly just an interest rate thing where the Fed jacked up the front end of the yield curve and the rest of the yield curve, you would expect the rest of the yield curve to start to normalize, that the longer rates would start to move higher, kind of reflecting a stronger economy, reflecting the new realities of a higher interest rate environment. That hasn't happened. It's become more and more inverted over the last 12 months to a point where we're now almost 100 basis points inverted, a full percent inverted, the 2-year versus the 10-year, meaning the 10-year is a full 1% lower than the 2-year yield. So it's a strange environment. And this is still suggesting recession. But again, there's reasons to think maybe it's not immediate, and maybe that 18 months is not quite applicable this time. But the fact that it's continuing to get more inverted is another thing that we need to keep our eyes on. We're going to go through a series of these relatively quickly. This is a purchasing manufacturing index and services purchasing managers index. They're both essentially in recessionary territory, but they're not deep in recessionary territory. So what it does suggest is disinflation. So I think the more important thing to take away from this is if it continues to go down, and this goes back through the 70s. So we saw a lot of volatility during the 70s, which could be an environment that's similar to what we're entering into, where we see these things just really go back and forth as inflation ebbs and flows. So we're seeing some risk here. It's not necessarily screaming recession at this point. It's trending that way, but it is definitely saying that there are some inflationary pressures that are decreasing, which is a good thing. Same thing with some manufacturing data. So this is Dallas Fed manufacturing data. We are in contraction right now. Recession maybe. If we look over the last kind of 18 months, almost couple years, this has been contracting. But we've seen periods like that before. It's not that abnormal to see. In 2015 and 2016, we saw a pretty similar environment as we saw right now. During this period, we saw a Chinese yuan devaluation, about a 20% decline in stocks. Here we saw a 28% decline in stocks so far. So it's not necessarily saying absolute recession. It's saying that recession is a risk, and recession odds have increased. But it's definitely saying that there's more disinflation, that there's economic activity starting to slow, and we should expect the inflation number to start moving down. Okay, portfolio positioning. We look at three different things here. So this is looking at the maximum equity exposure in our balanced portfolios, growth portfolios, and aggressive growth portfolios. So looking at the balanced portfolio, here's our target. This is what we were kind of pre-22. This is what we hope to be at in normal times. As of March, we were pretty low. This was when we did our webinar about the banking crisis following the Silicon Valley Bank drop. We were about 10% equity exposure. As you can see, this is the current as of today. We've really massively increased equity exposure over this is mostly over the last about 4 to 6 weeks. So we're getting signals that, that this market rise might start to widen. We might start to get some additional participation outside of those 7 stocks. So we've started to see that reflect in our models. You're probably noticing that if you're looking at your portfolio a couple months ago, if you'd see the market go up or down, it really was not moving at all. Now, if you're looking at your portfolio each day, you're starting to see, a little bit higher correlation, starting to see, on the up days, we're getting a 0.5%, 70 basis points up, have a little bit downside on the down days. So we're starting to see that participation, kind of increase a little bit more. This is an increase in a combination of individual stocks. The majority of what we've increased recently is that ETFs. So we've had a small cap ETF that we put into the portfolio a few weeks ago, mid cap ETF, an equal weight S&P, an equal weight NASDAQ. So it's the majority of what we've been putting in kind of recently have been in ETFs. But there have been some individual stock exposure that's been increased as well. And that's the case throughout the portfolio. So growth, again, a higher equity exposure than balance, still not quite up to where our target is, but a lot of progress being made to try to capture some of this growth. And if it starts to widen out, get some returns improved for the second half of this year. So quite a bit of increase of stock exposure. If we reverse, obviously we're not afraid to move that back down. But I kind of expect that potentially over the next few months that we will see the S&P start to flatten out. We will start to see start to see the small caps and mid caps start to play catch up. The equal weights start to play catch up to the broader equity markets. And in which case we'll start to play catch up to the benchmarks as well. So pretty big increase in net equity exposure over the last kind of few months. So just a couple slides left here. What are the risks and opportunities out there? A few months ago, we we're really only looking at two scenarios: a major bear market or a sideways chop. And I think it was kind of a coin toss of what was going to happen. Kind of going back to that S&P chart, still hadn't made any real progress, even though it's been a good year so far. It still was still looking like an overall bear market. We've seen a lot of positive developments happen recently. Hopefully that kind of sticks around. But now we can say, okay, well, maybe we are going into a bull market. So it's really going to depend on if we see a recession or not. So if we do see a recession, if that were to happen, we would see a big decline in stocks. We'll kind of talk about, on the next slide, what that's going to look like, or what could look like. And the opportunity is with a bear market. Major bear market lows are usually pretty easy to identify. There's massive panic. There's a lot of data. And a lot of signals that say that a major bear market is over. We haven't seen any of those signals over the last year and a half. The last time we saw it was in COVID, and we saw it in 2009. Those are both two pretty easy lows to see. But if we are going to go into a major bear market, I think commercial real estate's probably going to have to start getting out of hand. Start to see unemployment tick up. Maybe start to see some risk in the housing markets, but it needs to be more than just a mild recession. Sideways chop is really looking more and more like what we could be entering into, where we see kind of mini bull markets, mini bear markets, like the 70s, where we see a long period of sideways price action, maybe see a series of mild recessions. I think the overall market would feel very much like what we've seen over the last year, where it's really not, very good, but it's also really not that bad. And it kind of oscillates from feeling pretty good to feeling kind of bad, but it's not this runaway market that just goes on to new highs and doesn't look back. But it's also not the kind of bear market that, is a 2008, or 50% type of decline. We could see a long period of kind of choppy sideways prices being 5 to 10 years, meaning a long time. In that scenario, you want to focus on yield. Interest rates will stay relatively high. Let's just get income, pumping into your portfolio. So this is really starting to look like a more, probable scenario at this point. New bull market, this would just mean a recession isn't going to start for a few years out. We might still have one, but last year there was technically a recession. The first and second quarter were negative GDP, but it was kind of a technical recession, not a real recession. We could see some things like that happen. That would mean the commercial real estate just sort of flew under the radar, that banks were putting these commercial real estate loans into their workout group. They're continuing to make payments. We didn't see sort of a lot of supply hitting the market, where we saw big declines in some of the values of these commercial buildings. So we just sort of see it kind of push off. We'll kind of talk about that next slide. Obviously, if it's a good bull market, you want to participate in it. But it's now a scenario where it really didn't look like it was going to be much of a scenario a few months ago. So, that's a positive development. The opportunity there is just everywhere, really small caps and mid caps mostly. But there's just still a ton of opportunity if we do go into a bull market. That train hasn't left the station yet. So we can still be a little bit patient right now, because there is a tremendous amount of opportunity out there. Couple questions over here. I'll get to that after we finish this up. So let's kind of put this into numbers. So if we look at these scenarios, if we look at a deep recession, and if we look at that and we start to see unemployment really start to go up again, commercial real estate start to spread and see some contagion, a good way to look at it from a chart standpoint is just those COVID lows. So if we saw a major recession, we would probably go down and retest the lows from COVID. It's about 2,200 on the S&P. That'd be about a 53% downside. And this is good to kind of look at the risk reward of these two, of the large caps versus the small caps. So, 53% downside. Obviously, that could, be give or take. If there's a major bear market, a little less, 45% downside, still something you don't want to mess with, and you definitely want to avoid. So there's some real risks if we go into a deep recession. This is what I think is pretty interesting, these next two scenarios. If we saw a mild recession, we would at least most likely test the lows from October. The reason is that the markets have never bottomed prior to a recession starting. So if we see a mild recession, doesn't have to be anything major, both the S&P and small caps would probably go test their October lows. That'd be a 23% downside for the S&P and a 9% downside for small caps. Just shows you how much delta in that performance there's been over the last 8 or 9 months. So pretty attractive for small caps. They're pricing in recession because of exposure to those smaller banks. So they haven't appreciated that much off of those lows. So if we do see a mild recession, the small caps look like a much more attractive place to be, frankly, because they haven't seen this big run up due to the big tech companies. The other thing that's pretty interesting, I think, is if we did go into another bull market, this is where we say, look, this trend missed out on the boat if this is a new bull market. If we see that and we just said, okay, we're going to make new highs, we're going to make new all-time highs. This is what it would take to get back to that all-time high. So get back to the prices of early last year. S&P needs to go up 11%. Still some room, not great upside, but obviously if we see that, it could continue another little bit. So let's say it goes up another 10 or 15%. You've got a 25 to 30% potential upside, but just 11% to get back to where it was last year. Small caps, on the other hand, is pretty similar for mid caps, 35% upside. There's a tremendous amount of upside potential just to get back to where it was last year. So you could even say if we're in a choppy market and we kind of see overall stocks go back up to where they were this time last year, there's still tremendous amount of opportunity out there. Now, it's not really an NVIDIA stock. That's not where you're going to necessarily make the money. If we go into a new bull market, it's trading at 200. The PE is 200. It's not something that fits into our model, despite how well it's performed. But like I say, if we go into a new bull market, there's major areas of the market, not to mention all the individual stocks like even Amazon that could go up 40% and get back to where it was last year. If we go into a new bull market, it's just there's still plenty of upside there. So if you kind of look at the portfolios and what we've been doing in your accounts recently, you'll notice small cap, mid cap, equal weight. And that's where our signals have been putting us. So, bottom line, it really is going to come down to, are we going into a recession? How deep or not might that recession be? But on the whole, things are starting to look a little bit brighter than they were just a few months ago, at least for now. That's all the slides that I've got. Looks like we have a few questions out there. So one, COVID impacted education. What about productivity? Productivity is an interesting one. And I think COVID is now taking a little bit of a backseat to artificial intelligence, to AI. We'll put a report out on AI here in the next few months. But, there is the potential for a product using some of these chat GPT and the technology associated with some AI applications that can really change some industries, in my opinion. I don't know if we have any attorneys on the line, but if we do, I apologize. But I think that the legal industry, for example, could really get upended. You've got how many junior lawyers and legal assistants who are doing research and charging $100 an hour, $200 an hour to research all these cases, when you can type it into a chat GPT that would go into LexisNexis, a legal database, and give you everything that's applicable, give you a list of 20 cases that could be applicable to the case that you're with right now. So I think there's some productivity issues that is really could be a tailwind for the broad market. It could be a headwind for the economy, because we could see a scenario where unemployment increased and productivity increased. Accenture, for example, a consulting firm, publicly traded consulting firm, said that they reassigned 14,000 jobs because of chat GPT. They basically made 14,000 jobs obsolete. They chose not to lay them off yet, but they announced that they were reassigning 14,000 people and were replacing them with AI. That is basically in one quarter. So there really is potential for massive productivity increases from the adaptation and evolution of companies using AI to become more efficient, to better extract data, to more quickly address problems in their supply chain, to more effectively, deal with customer service issues. So AI, I think, is the main opportunity from a productivity standpoint. Some more questions. Oh, we've got a question about kind of the equal weight. Let me get a chart pulled up, if you would bear with me 1 second. And I'll share it on my screen. So here is a chart, equal weight. So if we kind of zoom in here, try to get one that just kind of shows the best. So the gold is a ticker RSP that's in client portfolios right now. It's an equal weight S&P 500 ETF. And what that means is that in the 500 stocks in the S&P 500 are normally cap weighted. So, Apple is 7% of the ETF. Microsoft is 7% of the ETF. NVIDIA is 3% of the ETF. So it's weighted based on the size of the market cap of the companies within the S&P. RSP is an equal weight, and that just means it takes all 500 companies and puts them the same weight. So, 1/5, 0.2%. Apple is 0.2%. Microsoft is 0.2%. NVIDIA is 0.2%. So it more evenly distributes the return throughout the 500 stocks. And here's where we've seen this divergence. We've got, especially from here, we've got the RSP going down and the S&P going up. So, it looks more like the small caps because you have smaller companies that are bigger representation in the equal weight versus the cap weighted. So there's the opportunity, and that's really the $1 million question right now is what's going to happen with this gap? Are we gonna see the bigger companies start to either pull back or stop rising so quickly? I think that's a very high likely scenario that the S&P kind of stalls a little bit. And with some of these developments that have happened over the last few months, and especially with this break higher, are we going to start to see these smaller companies start to play catch up? There's been a pretty high correlation over time. It usually doesn't vary by more than 5 or 10% in any given time, and it usually starts to close the gap. So this gap will get closed either with the S&P falling, the equal weight rising, or kind of meeting in the middle. But either way, it looks like that's an opportunity to have exposure to these equal weights and exposure to some of these smaller areas of the market that aren't so heavily dependent on those 7 stocks. That answer your question? We have any more questions out there? And look. Well, if you do come up with any other questions, please feel free to email me directly, jim.denholm@ironbridge360.com. We'll record this. We're recording this right now. We'll get that kind of edited and put it up on our YouTube channel. We'll email that out tomorrow. We'll post the recording on our website and social media tomorrow. So thank you for everybody for joining us. Please reach out directly with any questions and invest wisely.